All right, y'all, we should be good to go here. So, good morning and happy Friday. Hope y'all have had a good week. Pretty interesting week. So, here's a quick analogy. And this analogy, it'll make sense here in a minute. Think of a basketball team, right? With a basketball team, you got your starting five players. So, you got your point guard, your guard. So, you got your starting five on your basketball team. And more often than not, that team is going to play at its best and it's going to perform at its best when each of its five starting players are performing well. So with that analogy here, if we look at a few different sectors in the market, the market is going to be its strongest when financials and energy and transports and industrials and technology, etc., when the vast majority of the sectors across the board are performing well, the market will perform well. So keep in mind, we've been sitting here for a month on end with a good-looking structure to the daily squeeze in the S&P 500, but we're not getting anything out of it here. So technology, come on, tech. So if you look at a chart of the Qs here, the Qs have been one of the recent leaders. They've shown signs of leadership. You had a daily squeeze. The move we were looking for is already unfolded. So technology's been looking good, but the easy move, I think, is done and over with. We could go higher from here, but this isn't the spot to get aggressive. We'll talk a little bit about that in a second. The semiconductor sector. This has been really solid as of late, so I'm sure a lot of y'all have been focusing on NVIDIA, who's just, NVIDIA's going beast mode as of late. The semis look pretty good, but generally speaking, they made that move from the 21 up into about +2. So I'm not sure if that's a spot to get crazy aggressive. But more importantly, we start to look across the board. We look at a few different sectors, and there's a lot of things that are breaking down here. There's a lot of distribution and just overall signs of a loss of structure. So if you look at the transports, for example, the transports have been one of the recent leaders. There's been a lot of momentum here. Now things are starting to fall apart. You got a daily squeeze firing to the downside. This is pretty ugly stuff. So the transports, they've kind of kicked the bucket here. We can look at the industrials. And again, the industrials, there's been some recent leadership there. They've been pulling the market forward. However, over the last week or so, if this chart can load, the industrials are losing structure. There's a daily squeeze firing to the downside. It's a total loss of momentum. Check out the financial sector. Again, we've seen some recent leadership here. However, financials are starting to break down. There's a daily squeeze firing to the downside. What else is out there? So transports, they're breaking down. Financials are breaking down. The industrials are breaking down. Let's check out energy. Energy has been one of the strongest sectors as of late. Super, super bullish over here for energy. But energy came in hard yesterday. And now you got to close under the 21. Unless we bounce from here, energy is very likely to do the same thing the industrials and the transports have done, which is start to roll over a bit here. So going back to that analogy of a basketball team and its starting five players, thinking, with that analogy in terms of where does that make sense in the market, here's what we're looking at right now. Here's your starting five. You've got the industrial sector. In the industrial sector is dragging ass right now. You have the transportation sector. The transportation sector is leading the way towards the downside. You have the financial sector. That's breaking down as well. And now here's your two recent leaders, right? These are the two standouts who have been pulling the market forward, technology and the semiconductors. Here's the issue over there. They're extended. They're up here at +2, +3 ATR. If they're going to completely hold the market up from here, they have to get even more extended. So, these are things to take into consideration. If we're thinking in terms of this huge buildup of energy and this big drawn-out daily squeeze of the S&P 500, something has got to give here sometime soon. And while we're still chopping around here in this daily squeeze, slowly but surely, industrials are breaking down. Transports are breaking down. Financials are breaking down. That's going to put a lot of pressure here on the S&P 500. Maybe technology and the semiconductors are just so damn strong they hold the ship afloat here. Personally, I don't think that's too likely. So these are major things y'all have got to pay attention to. Daily squeeze here for the S&P 500. Once a few other sectors out there start to drop like flies, now there's a growing probability, especially if we continue to hang under that 21. Now there's a better probability this daily squeeze fires to the downside. And just like a daily squeeze firing long, at that point you're looking for a flush into -2 to -3. So, I've been bullish on technology as of late, but I got the move I was looking for, and it's the same move every single time. Give me a daily squeeze, I'll build my position there at the 21, but once the move that we've seen unfolds, I'm just going to take profits, and I'm going to wait for the next pullback. So here is where I think you get aggressive with the Amazons, the Googles, the Microsofts. You're taking profits on this push. You don't want to buy calls up here. You don't want to sell put credit spreads. It could continue to easily run higher, but in terms of probabilities, it's generally the move you're looking for. From the 21 into +2, and then you wait for the next dip. So, with all that being said here, let's just start to have the discussion that potentially the market is going to come in a bit, with the understanding that the market's going to do whatever the hell it wants to do. So we could be, at brand new all-time highs again next week. But just thinking in terms of sectors are breaking down, you got a daily squeeze for the SPY, then take into consideration you've got some timing cycles, etc. Let's just at least have a discussion of, if we do pull back here, where are we looking for support, and more importantly, where are we potentially looking to buy that dip, so to say. So what I'm going to show y'all here is a weekly chart. And here's my mindset with technology. We could pull back here all the way to that weekly 21 period EMA, and we're still looking at an incredibly bullish chart. Here was a big pullback to the 21. It felt ugly. It felt like on that Monday through Friday stuff that technology was falling apart, but really all it was in the bigger picture of the trend was a healthy pullback to the 21. Then you got your next move, and then we got to come back down, and then you get your next move. So potentially here, we do flush down to the weekly 21. It's the first place I'm looking for the market to find support, and it's the first place that potentially I'll start looking at some opportunities to get long. So, not to get too ahead of ourselves, but from a weekly charts perspective, just have that perspective, or just have that understanding rather. We could pull all the way back to the weekly 21, and it's still a really bullish market. It's still a really bullish trend, but that pullback to the weekly 21, that's going to bring you down here on a daily chart. So it's going to feel pretty ugly, but in the bigger picture of things, it's a pretty healthy pullback. And now for the S&P 500. So the SPY here, we haven't pulled back to the weekly 21, I think, since October of 2020. We'll take a look here. I might be wrong on that, but we haven't pulled back to the 21 in quite a while. All right, so the last time that we'd actually touched the weekly 21 was October, November of 2020. So it's been quite a while here since we got that full healthy reversion to the mean. We got pretty close over here, but this just shows you the strength of this market. We didn't even touch the weekly 21. We didn't even touch it. So we haven't come back to the 21 fully since fall of last year. So from that perspective, if we line up the weekly 21 here, now take into consideration you have a daily squeeze that could fire short. If the squeeze fires short, I think a move down towards that weekly 21, it's a good level of support to focus on. And just like the Qs, if we do find support there, then we start to have discussions of, can we go long? Can we find some opportunities to the upside? And again, I can't stress this enough. This move doesn't have to unfold to the downside. The reason I'm having this discussion is that people tend to lose their crap when the market drops a little bit. There's just way more emotion involved. I'm trying to give you all a healthy perspective, where on a daily charts perspective, a flush to 4,100, 4,050 is going to feel pretty damn ugly. It's going to seem like pretty ugly stuff, but from a weekly charts perspective, it's a completely healthy, and I would even argue potentially a much needed dip here. It's not a dip that's going to break the entire structure or the trend of the overall market. So hopefully that makes a little bit of sense there. And sticking with the game plan that we discussed on Wednesday, was looking for a little bit of momentum here into the end of the week with the Google positions, etc., take some profits. So that's what I did yesterday. You had the Fed come out on Wednesday, things got ugly, and then yesterday things got crazy. So I'm all out of Google, took my profits off the table here. And up here at plus 2 ATR, it's for me, it's just not the ideal spot to get long. So technology could continue to run here. Maybe Google gets to 2,500. On a dip to the 21, I would consider it. Same thing goes for Amazon. You have this beautiful, beautiful weekly squeeze. The daily chart looks super strong. But the last place on earth that I personally want to start to load the boat on Amazon is up here at plus 3 ATR. It could keep going, or I could jump in here and get my ass handed to me. So I'm going to choose to not get my butt handed to me. So, on a dip to the 21, maybe some Amazon. But I think for me here, being very cautious to the upside, and I do have a hedge on. So if I want to go long over the next 2 to 4 to 6 weeks, I got this hedge on. It's going to make my life that much easier. Call it an insurance policy in my back pocket. I can take a long position, and if it craps on me, I can cover it here with the hedge. So for the SPX, I got a August monthly expiration call credit spread, and I sold calls up here at 3,300. And that was a pretty good risk-reward ratio. I think on 10 contracts, you were risking about $11,000 to make $8,000. So on one contract, you're risking $1,100 to make $800. So I like that as a hedge. It's a hedge where, a few weeks from now, a few weeks from now, I can bring in some really good premium, even if the market doesn't roll over. So ultimately, for this trade to work, I just need the market to not be above 4,300. And if we do roll over to the weekly 21, it's going to be some nice quick premium. But if we just go sideways for a month, I'm still going to profit on the hedge. So I've got that trade in place, and that's pretty much about it here moving forward. There's still a lot of good-looking setups out there in the market, but here's the issue. As goes the market, goes the stocks. So, Waste Management, Pepsi, McDonald's. I mean, there's a lot of good-looking squeezes out there, but they're all most likely going to go lower if this daily squeeze fires to the downside. So, a few things for y'all to take into consideration there. I just don't think the time to be crazy aggressive to the upside. And I think if you're going to be trading to the upside, you got to do so with a hedge in place. It's just my 2 cents. A few more things to look at here. VIX is already kind of going here. So keep an eye on the volatility index. Before you start buying dips or looking to get long, you want volatility to die back down. So generally the worst time to think about getting aggressively long is when the volatility index looks like it wants to fire a daily squeeze to the upside. It can be pretty short-lived, but just to drive the point home here, you wouldn't have really wanted to load up the boat on longs on the 10th of May. So on the 10th of May here, volatility is just chilling. You get the daily squeeze, then you're looking at 3 or 4 days of some ugliness. So if you look at the SPY here, and we look at the 5th of May, or the 10th of May rather, you would have been getting long that day right here. Now, it was short-lived. However, I don't know about y'all, I don't like jumping in when the odds favor a potential flush down to -2. But if anything, I'm going to get long after the flush to -2. So just all different things that are kind of lining up here. But still move forward with the acceptance that the market is going to do what it wants to do. There's nothing stopping this market from being at new highs by next Monday. Just thinking in terms of probabilities, once the flies start to drop, so to say, and here goes your industrials, and they've been a recent leader, but now they're starting to break down and they're losing structure. That's not doing the S&P 500 any favors. The transports, they start breaking down, they're firing a daily squeeze short, they lose momentum and they lose structure. That's definitely not doing the S&P 500 any favors either. You can look at the financials. The financial sector, again, it's been one of the stronger sectors. So we're looking at recent leadership here that now potentially is thrown in the towel just a bit. You're losing structure, you're losing momentum. No more stacked EMAs. Your daily 10x bars are neutral, so you're losing momentum there. And there's daily squeezes firing to the downside. So pretty much here, to drive it home, you get a daily squeeze just like this in the S&P 500. As the different components in the SPY start to fire short and roll over, thinking in terms, again, of probabilities, what does that potentially do to the overall market here? There's all that pressure in all the different pockets of the market that make up the SPY. If they start to release their energy to the downside, it's putting a lot of pressure here on the SPY. So, a few things for y'all to focus on. But an interesting week. Holding positions through the Fed is never the most enjoyable thing. So for Google, those trades worked out. It was some nice profits. So that kind of ends. My job here on Google is pretty much finished unless we get a pull back to the 21. But started building positions over here. Took home some profits. Built a few more positions. Got what I was looking for out of Google. But not the easiest move to sit through this week. The Fed comes out, technology starts rolling over. We're down, I think the Qs were down, like 1.5%. So I'm sitting through this beautiful drop. I had short strikes at 24.10. So that was getting sketchy. And then the next morning, everything's ripping towards all-time highs. So not my favorite, kind of price action to get involved with. Now, a few more things we can take a look at here. Just kind of general important principles to keep in mind. Again, just for the sake of conversation here, let's say for the next 2 to 3 weeks, the path of least resistance is to the downside in the market. You still want to pick your shots wisely. So the transports here, this is not the time to get short. I hope we can all agree on that. Based on the things we focus on every morning, for the same reasons we don't want to get long at the plus 3 ATR extension, we're not going to get short down here either. Now, easily the transports could continue to roll over. Just as easily, there's a growing probability it's going to bounce right back up towards 21. That's where you want to look to short it. You don't short down here at -3. You short on the bounce back to the 21. The industrials are the same thing. So, shorting a Caterpillar, shorting a 3M here, I think you missed the easy entry. If we can get a bounce back up towards the 21 or even to -1, that's where you're looking to short. But not down here, not down there in the hole, so to say. So I do think, and remember, I can't give you all financial advice or I'm going to end up in jail. But if I was looking for a trade to the downside right here, I'm going to do it on the market. I'm not going to do it on the transports down at -3. I'm not going to do it on the financials or the industrials at -3. I'm going to do it right here on the overall market. Because at the end of the day, my favorite trades are just always going to be a squeeze. If I'm looking to trade a squeeze long, I'm just looking for the bullish structure. But if I want to go short, my favorite setup is still the squeeze. It's still the buildup of energy. Now you're looking to catch that flush down to -2 to -3. So that's what I would look to put a short position on. Just simplify the process. Do it on the overall market. Because we haven't made the flush, we're not extended, and structurally, energy has to get released here. So if you can build a position inside the squeeze and then we do catch that flush, your life is just so much easier than getting short transports at -3, and now you got to sit through a potential bounce. So I think you look for things that are close to their daily 21 EMA. I do think Netflix is still a short. The difficulty here, I don't want to call it difficulty, but the thing to take into consideration is earnings is around the corner. That is another reason I think maybe you think about short in the market. So if you look at the daily chart, get this whack daily squeeze, negative histogram, negatively stacked moving averages. There's no momentum here. And then your weekly squeeze, I think the weekly squeeze over here has got a bearish structure to it as well. Negative histogram, no stacked EMAs, no green 10x bars. So I like the idea of Netflix firing down to 460, 450 if the market pukes it up a little bit. I love the idea of that. Only thing you got to take into consideration is earnings is coming up on the 20th. So I think a good short setup, just taking into consideration earnings, is creeping up on yo ass. And then Tesla here. I think Tesla, come on now. I think that is shortable as well. You just kind of pinned under your weekly 21. Think of how strong the market has been over the last month to 2 months. Tesla doesn't participate at all. So if the market does puke it up here a little bit, I think you can see Tesla do the same thing, but they've got earnings on the 21st. So, with the mindset that as goes the market, goes the individual stocks, I'd like a short here on the SPY. If you want to go short, if you want to hedge, I think you do it here on the index. You don't got to worry about earnings, and you don't got to worry about upgrades and any of that other funny business, and it hasn't made that extended move to the downside yet. So I think you simplify the process. You look for the short there, if anything. But just respect the same rules that treat us well when we're going long. Build positions near the 21. Take profits on your move into the -2 or -3 extension. Same thing we do when we're going long. You build your long here, take profits there. Michael, you could do either or. You could sell a call credit spread, or you could buy a put debit spread. It's just going to be a matter of preference. For me, the benefits, because there's downsides, there's benefits to each. The benefits of me doing the hedge the way that I did it on the SPX and selling those out the money calls is, at this point, I don't even need the market to drop. I don't need the squeeze to fire short to potentially walk away with some profits here. So I do think the market could flush nicely here, but ultimately, as long as we're not back above 4,300, I'm going to slowly collect some premium there. With the debit spread, ultimately you're going to need that directional move to bring home a good chunk of your profit. So that's just my preference across the board when it comes to option strategies. Based on the structure and based on all the discussions we had this morning, I'm pretty confident there's some decent potential here that we do flush to -2 to -3. However, if the market goes sideways, I'm still going to bring home some profit. If the market just goes down in a slow, choppy fashion, I can still bring home some premium. And even if the market rallies a bit from here, as long as we're not going above 4,300, I can still bring home some profits on that. That's just my preference. So let's do this. We got 7 minutes left, and we got to find a couple of squeezes here on the futures to serve as our compass this morning. All right, so let's clean it up. Obviously, we got the daily squeeze. And remember, with a squeeze, +1 to -1 is the buildup of energy. Once we start closing under or above +1 or -1, now potentially that squeeze is getting on to phase 2, the release of the energy. The release of energy typically is bringing you towards the 2 or 3 extension. So key level of support here, so to say, is going to be this recent low, simply because that lines up with -1. We start to get a couple closes under -1, I think in pretty short time, you get that flush to -2. So keep an eye on that as a key level. And then if we look for squeezes here, yeah, we're down almost 1% now. Nothing is setting up here on the 4-hour chart. We're looking for squeezes that are currently setting up or have any squeezes fired to the downside. So here's a 2-hour squeeze. It's getting really close to firing short. So if that fires short, there's a little bit of momentum to the downside. You've probably got an hourly squeeze here. Let's see. Man, Thinkorswim is slow. There you go, right? Chop, 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 build up energy, build up energy, build up energy. Here comes the release of energy. And if this continues, then that can trigger that 2-hour squeeze. The 2-hour squeeze gets weak enough, that can trigger the daily squeeze. So you're looking for a bounce here in the market to avoid that kind of flush. Then a few more things to cover real quick. So yesterday I made the decision to take really modest, small profits off the table over here in Costco. So, with Costco, it's probably one of the best looking charts in the entire market. No exaggeration. I think this looks really, really good. However, we talked about this on Monday and Wednesday. It's a reflection of the overall market. It's got a good structure, but it's going absolutely nowhere because the market has been going absolutely nowhere. If the market does drop from here, there's a really good probability, regardless of how good the setup looks, that Costco is going to follow the market lower. So nothing to do with the structure of this setup here, more so just looking at the overall market and saying, do I want to have a bunch of long positions right now? Took off the profits on Costco. So I think it was 25, 30% of max profit. So nothing to write home on. But another good example of why I like to put credit spreads. I caught zilch here. I caught nothing in the form of a directional move, but I'm bringing home a little bit of premium simply for sitting through some chop here. I'll take a look at a few here. Let's see what Bob is looking like. I mean, remember, guys, right now, and I'm not trying to get like super bearish with y'all, right? I'm a flexible trader. I'm not bullish. I'm not bearish. Whatever the market wants to give me, the market's going to give me, and I'll take it. But the most important thing for y'all to keep in mind right now is that as goes the market, goes the individual stocks. So have that understanding. We could look at BABA. We could look at 30, 40, 50 charts this morning. They might all look as good as Costco, like picture perfect, fits the bill. This is everything we're looking for to get long, but it could all be meaningless if the market does flush from here. So I'm not trying to come live this morning and say, hey, the market 100% is going to flush, but we always want to think in terms of risk management first. So you can show me some of the prettiest setups in the market this morning. It doesn't matter. If the market holds up just fine, you're going to be in great shape. If the market drops to -2 to -3 ATR, if we pull back to that weekly 21, there's just a really, really good probability your long position is going to go down with it. I think that's the most important thing to keep in mind here as we head into the open. So listen, y'all, good stuff. I'm going to jump into the Focus Trades Discord chat. So if you're not in there already, you can... The link to the chat should be in the description of all of our videos. So come on and join us over there. If you got any questions throughout the session, I'll be hanging out. And then for y'all in the simpler room, I'll be seeing you in an hour. But I hope you had a good week. I hope you have a relaxing and safe weekend. I appreciate you tuning in, and I'll talk to y'all soon. Finish strong today.